How much risk do you want to take is an important question every investor needs to ask themselves. It's important to know that investing doesn't have to be a white-knuckle experience. Some people like to dive into the deep end of a pool, and others prefer to stick to the shallow end. And with investing, you can choose aggressive, volatile investments, and you can choose conservative, low volatility investments as well. More importantly, you can choose to be anywhere along that spectrum you like. If we take a look at a long-term chart of the Canadian stock market, represented here by the S&P/TSX Composite Index, we can see that over time the chart moves up. But this is a 30-year perspective. We can see that there have been times where returns have been negative. For example, someone who started investing broadly in Canadian stocks in 2007 experienced some big losses early on. But 10 years later, had they stayed invested, they might have seen a healthy return on their money. Investing entirely in stocks is aggressive. The trade-off is that while you have the potential for large gains, it comes with more risk. Risk can mean more volatility, which means values that fluctuate a lot, both up and down. And risk can also mean the chance of losing money permanently if you are poorly diversified and invest in a company that goes bankrupt. The good news is that not only can you choose the general level of risk you want your investments to be exposed to, there are many ways to manage risk. One example would be to diversify across many different investments. That way, if you do pick an investment that does very poorly, not all your eggs are in one basket, as they say. Another way is to invest only part of your portfolio in higher risk investments while also having exposure to lower risk investments as well. And there's no rule that says you can't have your entire portfolio in lower risk investments either. One of the factors that will help you decide how much risk you want to take is time. You'll sometimes hear this referred to as time horizon. Essentially, your time horizon is the length of time you'll be invested before you need to take the money out. If you're 20 years old, your time horizon for investing for retirement could easily be 40 years. This allows for people who want to take more risk to have more time to recoup any big losses. If you think you'll need to access the money you are investing in less than 10 years, this may limit how much risk you want to take. And if you think you may need your money in 5 years or less, you may want to avoid taking much risk at all. And while having a long time horizon gives you more time to recoup losses, it doesn't mean you have to take on a lot of risk. Many investors choose a more balanced, middle-of-the-road portfolio for long time horizons simply because they don't like to take on too much risk. One final very important point is that there is a difference between long-term investing and short-term speculation. Short-term speculation is when people buy and sell stocks with very short time frames. It's not uncommon, it's very aggressive, and while you might hear some stories about people who've made big gains in short periods of time, you don't tend to hear as much from the people who have made big losses in short periods of time. When deciding on what type of investor you want to be, one of the most important things to consider is finding what is right for you and your goals. When you're just getting started, it's important to know that you'll likely continue to learn more about risk, how you react to risk, and how much risk you have in your investments for different goals over time. Almost no new investor has figured out what type of investor they truly are when they make their first investment. There will be a learning curve. And remember, if you need help, you can also choose to seek varying degrees of assistance. Maybe you need a bit more help when getting started, and one day you might decide to take over on your own. And maybe you'll find having someone to delegate to is better for you. There is no one size that fits all.